Have you ever wondered which regular investment vehicle will produce the best result when you want to take money out in the future, assuming growth is equal? Well, today, perhaps for the first time, you're going to get a definitive answer. We'll look at the two main tax-efficient retirement wrappers, pensions and ISAs, and I'll use my cash flow modelling software to clearly demonstrate which would come out on top in a few different scenarios. If you're new to investing in retirement planning, don't worry, I'm going to simply explain the differences between ISAs and pensions first, which are both fantastic tax-saving vehicles, and also how you can maximise their benefits to you. So when you're relaxing on a Caribbean beach in a few years' time, cocktail in hand, basking in the sunshine and listening to the waves gently rolling in, remember to raise that glass to me. If you're here for the first time, I'm Chris Bourne. I'm a financial planner specialising in helping people achieve tax-efficient financial independence. So subscribe if that's the sort of content you're looking for, turn on those notifications, and let's get started. So first of all, what are these two investment vehicles, pensions and ISAs? How do they work and what are their main benefits? Well, if we start with the similarities, they're both types of tax incentivized accounts available to UK investors, which allow the holder to make regular or ad hoc lump sum contributions. They both offer tax advantages, albeit different ones, and they both allow you to hold a variety of different assets. They also both have limits on what you can pay into them every year. The important thing to remember about both of them is they're not investments themselves. They're wrappers into which investments can be placed. The wrapper determines the tax treatment and the investments you hold determine the return. Those are the similarities, but what are the differences? Well, starting with pensions first, they're broadly split into two categories: defined benefit schemes and defined contribution schemes. Defined benefit schemes are only available through an employer. They're not private arrangements, and they're schemes that provide some sort of guaranteed benefit at the end, such as a guaranteed income linked to your employment earnings. They include final salary schemes and career average earnings schemes. They can be very valuable arrangements, but as they're only accessible through certain employers and you can't open one directly, I won't spend too much time on these here. Defined contribution schemes are those where there is no guarantee of future benefits. You just choose how much is paid into them, hence defined contribution. They're also sometimes called money purchase schemes. Defined contribution pensions include personal pensions, SIPPs, which stands for self-invested personal pension, and master trust workplace schemes like Nest. The types of pensions you'll generally invest into, if you were to set one up yourself or through a financial advisor, will be personal pensions or SIPPs. There are subtle differences between the two, but the lines are a bit blurred these days. In essence though, a SIPP just gives you wider investment powers. SIPPs can invest into a much larger range of collective investment funds, investment trusts, fixed income securities and stocks. They can also invest directly into commercial property, such as shops, offices, factories, anything with a business use. Not every SIPP will offer this functionality though, because it is more of a specialist area. A SIPP can even borrow up to 50% of its assets in order to purchase a property of higher value. In terms of what you can pay in, you can make contributions of up to £40,000 per tax year into a pension, but only if you earn at least that much in salary, or if an employer or your own company is making the contribution on your behalf. If you were making your own private contributions and earned less than £40,000 a year, your limit in order to receive tax relief on your contribution would be your gross salary. But anyone can pay in up to £3,600 a year, even without earnings. A lot of people don't realise that they can actually make pension contributions for a child as soon as they're born. The major taxation advantages of a pension though are in the tax relief that's awarded to you on the contributions. If you're paying your own money into a pension, the amount that you invest is increased by 25% straight away by HMRC. So if you paid in £100, £125 would be invested for you. That immediate growth is then able to benefit further from compound interest, which is growth on your growth. I'll be able to demonstrate the power of that a little later. Not only do you get that tax relief, but any profits you make when you sell investments within that pension wrapper are completely sheltered from tax, whereas you'd normally have to pay capital gains tax on those gains. All dividends and interest are sheltered too. When you decide you want to take income out of your pension, you have to do something called crystallize your benefits, which you can't currently do until you're 55, and that's rising to 57 in 2028. For more information on that, check out the videos in my UK pension drawdown playlist, which I've put in the description below for you to check out after this video. At that point, you're able to take up to 25% of the value of the pension tax-free, and then the remainder is subject to income tax, which is the opposite to an ISA. A nice, neat little segue into ISAs. ISA stands for Individual Savings Account. What it simply does is ensure that all of the returns you get from investments within your ISA account are tax-free. You pay no tax on gains and no tax on income. Like there are different types of pensions, there are broadly 3 types of ISAs and 2 additional what I call subcategories, which are lifetime ISAs and junior ISAs. In the interests of time and simplicity though, I won't talk about those here. The main 3 are cash, stocks and shares, and innovative finance ISAs. A cash ISA is just a cash savings account, usually with a bank or a building society, that pays you an interest rate on your money. A stocks and shares ISA holds market-based investments like shares, ETFs and collective investment funds. And an innovative finance ISA holds peer-to-peer lending investments, where your money is used to fund borrowing by individuals or companies for which you get paid an interest rate, usually higher than what you could expect from a cash ISA. All of them have different levels and types of risk, and you can pay in up to £20,000 per year to just one of them or a combination of them. Not more than £20,000 total though. Unlike pensions, there's no reference to earnings with that limit. Everybody gets the same allowance. You can invest into a wide selection of different funds, ETFs and stocks through ISAs too, but they don't allow you to hold direct commercial property like you can in a SIPP. There's no restriction on when you can access your money though. You can take it back at any time. The main difference in tax treatment between pensions and ISAs is that with ISAs you don't get any tax relief on your contributions going in, but there's never any tax when you take money back out. That's why some people say that ISAs give you the greater advantage. They say that pensions give you a bonus at the start, only to take it away again when you start drawing income. But are they right in saying that? Well, using my cash flow modelling software, which has the full UK tax framework built into it, we're able to project forward and finally get the answer to that question. I've built 2 models, one assuming pension contributions are made and the other assuming stocks and shares ISA contributions are made. We'll pay the same net amount into each of them every month for 20 years. In this example, £1,000 a month. We'll assume that both plans generate a net return of 7% a year. Not a guaranteed growth rate, of course, just for the purpose of comparison. We'll then say that the investor plans on taking an income of £25,000 a year in today's terms, which adjusted by 2% compound annual inflation would be about £37,000 in 20 years' time. And the first scenario will assume that the investor is a basic rate taxpayer now, and they will be when they retire. Check out the details in the description below for the other assumptions used in this comparison. So looking at the pension investment scenario first, this is a cash flow model. It shows when or if you're expected to run out of money. Every bar represents a year on the timeline. So these are the early years when our investor is still working, and this is when they reach retirement and start to draw from their pension. We can see that a bit clearer if we look at the detailed view. So based on those £25,000 inflation adjusted annual withdrawals, they're running out of money at around age 88. How does that compare to putting the same £1,000 a month into the ISA then? For it to be better, we'd be looking for the shortfall to appear later in the timeline. We can see from this comparison chart though, which shows the pension here and the ISA here, that that's not the case at all. The ISA capital is expected to run out at about age 79, a good 9 years earlier than the pension. That can be best explained by looking at the assets comparison. We can see that Whereas the pension is worth nearly £621,000 at age 57 when withdrawals start, the ISA is worth just £489,000. That's simply because the £1,000 paid every month into the pension has immediately become £1,250, an extra £3,000 every year, which has been able to attract further growth. So even though there'd be tax to pay in retirement on the pension and there'd be no tax on the ISA at all, the sheer additional compound growth achieved on the pension has outweighed the tax impact. What if you were a higher rate taxpayer during your working life though? What difference would that make to the models? Well, it doesn't make any difference to when the pensions and ISAs would run out, but we can now see that on the pension investment model, there's this little extra purple slice on top of each bar in the year after pension contributions are made. This is higher rate tax relief of a further £3,000 every year essentially added back into the plan. That's £60,000 extra over 20 years that could be invested for more growth. So you'd be even better off if you were a higher rate taxpayer while working and a basic rate taxpayer in retirement. However, what would the situation look like if you were a higher rate taxpayer while working and you remained one in retirement? Let's say you've got rental income from properties, or you've got defined benefit pensions that keep you in the high rate band. Does that change things? Well, we can see here that it certainly does. I've increased the annual expenditure requirement in these models so that the same level of withdrawals are still needed from the pension and ISA despite other taxable income coming in. And we can now see that the much higher taxes would mean that the pension is projected to run out at 77, about 3 years before the ISA. So you can see from this that your own personal situation will dictate which wrapper may be best to focus on. I still believe that both work well in unison together. These are extreme examples, of course, and everybody's situation will be different. But it's another reminder that tax relief and compound interest are very powerful forces when combined together. Whether you have to pay taxes or not, it's the net benefit at the end of the day that matters most.